Hi, well, good afternoon, James. Nice to have you with us. James is manager for the Rathbones Global Opportunities Fund, which features in 3 of our model portfolios as a core holding for moderate to speculative and speculative portfolios. James, you've had some very good performance over the last 5 years, and particularly over the last 12 months as well. How have you, as a stock picker in a global fund, how have you been able to achieve this?
Well, I mean, the economic situation changed quite considerably in about April or May of last year. Conditions deteriorated quite rapidly. So I'm on the ground looking at these companies on a daily basis. I noticed quite a significant increase in the number of profits warnings being issued by companies across the spectrum, across the world, in fact. So what I did was de-risk the portfolio. I increased the amount of cash in order to protect my investors from some falls ahead. And I instituted a program of what I call weatherproofing. So this is buying more defensive, reliable, predictable businesses whose growth isn't entirely affected by the economic cycle. So these are companies in all parts of the world, companies in the tobacco sector, even some retailers at the bargain end of the retail space. So, for instance, in the UK, I own Primark, which is a part of the AB Foods empire, because I recognize that consumers are looking for value. In the United States, I bought dollar stores. So you go into a store in the United States and they sell everything for $1. So it's easy to budget and it's cheaper for the consumer. I've bought some healthcare names. I've even bought a funeral home company, which is, sadly quite a predictable business in every sort of economy. So I think that provided some good insulation for the fund through choppy markets, but it's starting to look like we're emerging from a difficult economy and things are starting to look a bit better.
Yeah, that's interesting. One of our strategies in sort of what we think are probably low return type markets is having diversification within our models with fund managers who are looking to get a good return from yield, from dividend yield on their holdings, whereas your fund has obviously had a very low emphasis on providing dividends. Do you think this puts you at a disadvantage going forward?
Maybe in some markets it does, but I actually think that the greater advantage in the longer term is some flexibility. Now, I do invest in some companies that pay dividends, and they have very healthy yields and return cash to shareholders, and I can pay that out. But other companies where I feel that perhaps it would be better for them to keep the cash and actually invest it in their own businesses and use that money to grow even further. I think if that makes sense, if return on investment is high, then it's a good idea for them to put more money back into the business. So I certainly wouldn't put down a dividend yielding strategy, but for the most part I like flexibility and I'm primarily looking for growth. And in my own personal portfolio, for instance, I have some funds which pay dividends and I also have some growth-oriented funds as well, and it's probably good to have a nice balance of the two.
That's how we've structured our portfolios. One question that seems a bit unfair perhaps is that on a more general macro scale is we've all been scratching our heads at what's been going on with Europe just lately and this sort of Greek bailout, and we're not sure whether it's a credible long-term plan or whether it's a bit of the major economies buying, major European partners buying time to figure out what they're going to do when Greece does default.
Yes, I struggle with it as well. And from an investment perspective, I've taken the view that I want zero exposure to peripheral Europe. So Portugal, Italy, Greece, Spain, Ireland. But you're right, there has been, they've bought time. The European Central Bank has given 3-year loans effectively at very low rates to the European banking system. And what that's done is really prevent a calamity. Yeah. But it's sort of like giving a junkie a fix. It won't be long until he wants his next hit. So I don't think this is actually treating the underlying problem, which is too much debt. and it's going to take a number of years to deleverage, to reduce the amount of debt in the system, both personal and in the banking system. So I tend to agree. I think we're going to have a number of years of slower growth, slower trend growth, uneven equity market returns, probably lower than average equity market returns, and I'm afraid that's just the world we have to live with. So I've been perhaps putting a bit more firepower into the United States, UK, and into Asian businesses.
Yeah. One last question, if I may. Markets have recovered pretty well since August. Do you think that now is a good time to take a bit of profit, take some risk off the table, or are you still happy for the long term?
I'm actually still bullish, but I'm bullish on a short-term basis. When you're looking forward perhaps a year, then the crystal ball gets a bit cloudy. But we are seeing things get better, without question, particularly in the United States, but actually a little bit in Europe too. Inflation is falling, unemployment is stabilizing, if not improving. Leading economic indicators in the manufacturing and the industrial sector are turning up. The housing market is stabilized in the United States. So actually things are improving, even though if you watch the news reports in the evening, you wouldn't really believe it. So I think perhaps for the short term, things are looking better. I've been putting some of the cash war chest I have in my fund into the market. I've taken my cash levels from 20% down to 8% in the last 4 months. So I do see things improving. The fly in the ointment is that I think over the next several years we're going to be in these short, sharp cycles where things get better quite quickly and then perhaps they trail off. And the thing to watch, the thing I'm watching most closely, is the rate of inflation. As inflation falls, as it is at the moment, it acts as a stimulus for consumers. But as inflation rises, perhaps next year, that will act as a brake on growth, and that perhaps will bring things to an end for the time being. So shorter, sharper cycles, you're going to need fund managers to be pretty nimble in this environment.
Stay vigilant. Well, we hope you found that interesting. A big thank you to James from Rathbones. Thanks a lot.
Pleasure.